Truth is, I thought it mattered. I thought that
money
mattered. But does it bollocks? Not compared to how people matter.
Welcome, Mention and other fine folks, to the Sunday Dispatch of the Black Letter, where we contemplate thoughts worth thinking. This is your spectator of the spectacle coming to you live from deep inside the Upside Down. And boy, is it really topsy-turvy out there this fine Saturday morning. There's a lot going on, so let's get right to it. Judge approves Hertz $1 billion stock sale. Even the company's lawyer admits the stock might be worthless. This is astonishing to me. I've never heard of this happening. I'm not sure if it has happened that often, but here we are. Hertz is going to be able to sell $1 billion of stock while it's bankrupt and going through bankruptcy proceedings. What this will do is dilute the shares that are there currently, and if they get through this bankruptcy properly, then those shares will become worthless, most likely. That's usually what happens, right? Because they reissue new shares as a new company after bankruptcy on a stock exchange. So this is just insane. Between the day of the filing and Friday, the number of Robinhood investors trading Hertz quadrupled to 160,000, according to RobinTrack, which offers data on trading by Robinhood users. You have all these guys sitting at home watching CNBC that look at that and say, I don't want to pay $60 for stock. Hey, Hertz is just $2. That's a hamburger at McDonald's, you know. They can go to the creditors and say, our stock is not at zero. We have equity value here. Our trademarks are worth something. It's a very different conversation than if the stock's at zero, Mazzari said. And this guy, I think, is out to lunch. It's not a different conversation. If I was a creditor of Hertz, I'd say, you go knock yourself out. You now have extra money that you've created from the stock sale that we will take, thank you very much, as part of our credit. And then what happens is that these folks are left holding an empty bag, and these folks being the young Robinhood investors. So it's really, you're playing with fire if you're investing in penny stocks. And this is what Hertz is at $2. Anything under $5 nowadays really is considered penny. So penny stocks are like playing with fire. But it just shows you the madness that we're under. People have no idea what they're doing. There's speculation rather than investing going on in the market. 5 things investors like to say that end up costing them money in the long run. And this is highlighted in pink or reddish because it's not investors, it's traders. This really applies to traders. So what do we have here? I'll sell that stock when I break even. And this is true. Investors need to know when they need to get out of a stock. If it's losing their money and the underlying value fundamentals have changed, you need to get out even if you've lost money on it. That stock is too expensive. Again, this goes back to the idea of most likely the price and not necessarily the value of a stock. A $100 priced stock can be very valuable and undervalued, and a $1 stock such as Hertz or $2 can be cheap but not undervalued, especially if it's going bankruptcy. And here's the same. So the stock is so cheap it has to go up, and that's not the case at all. Now, of course, the market cap of a company will generally dictate the amount of growth it can achieve, arguably, although we've seen this tossed out the window lately too. Apple is a $1.5 trillion market cap stock, is making huge gains, but generally stocks that large will usually make more modest gains just because of the size of the market cap. A dividend cut is already priced in. This is the whole idea of the market is forward-looking, which I call BS on. I don't think the market's forward-looking at all. As I've mentioned to you before, it's just a bold hive mind, manic depressive mentality, really. Bank stocks or any sector will always be a good investment. And again, this is not investing, this is trading. Something's down, you think it's cheap, so you go and pile in. It's not necessarily the case. Anyway, just some thoughts. Some of these 5 things I thought were fairly accurate and interesting for folks to learn about and read. Especially if you are looking at getting into the stock market, although I certainly am staying away from it right now, except that I'm short the market. But other than that, I'm not getting back in until, well, it'll probably be next fall maybe, when we start to bottom out, I think. We've got a lot of pain ahead of us. U.S. manufacturers struggle to keep workers in face of weak demand. So we have a story here about Cheryl Wellman was able to bring back most of her furloughed workers last month with the help of a special government loan known as the PPP, the Payroll Protection Plan. Now she's laying them off again, right? So that's pretty brutal. Some of the strength in the U.S. payroll report for May, which included a startling 225,000 manufacturing jobs added, was the result of companies taking part in this program. So I don't think anything was added. If anything, they miscounted folks going back to work who had been furloughed as newly added jobs, when in fact they weren't, because their jobs had never been made redundant anyway. So that's an interesting article just about the PPP loan, the program that's out there, and how the impact is most visible in some of America's biggest industrial names. So Caterpillar and Deere, for example, expect to see about a 30% drop in revenues in the current quarter compared to a year ago. Some US factories are booming. Apparently it says here that Detroit is rushing to build trucks and SUVs, for instance, and Polaris, the maker of all-terrain vehicles and motorcycles, recorded record sales in April, May. That won't last, if that is in fact the case. So with all of this in mind, folks telling us how we are doing so well and everything, I thought that this song, this portion of the song here from the Vapors back in my vintage was appropriate. We'll just have a listen quickly. Yep, we are turning Japanese. And when I say turning Japanese, the Japanese have tried all this monetary intervention, this infinite QE forever. I think one of the stats I read is that the Japanese central bank, or whatever they call themselves, Central Bank of Japan, I think, the CBOJ, owns, I think, up to 80% now of the stock market, the Nikkei index, I believe, through ETFs. Their stock market has done nothing for probably the last 30 years other than go down slightly. So this doesn't work. And of course, as Mike Maloney has said from Gold Silver, that Japanese at least had North America and Europe to sell to during that time. This whole world is going into a global pandemic and a global depression, so who's going to sell to whom, right? And who's going to buy what? This is going to be a very different outcome. Kramer thinks Wall Street pros may be playing a game with amateur Robinhood traders. It's an interesting idea. It says here, look, here's what they do. They buy in the early morning and then they flip it to Robinhood types when the market opens up and they make money. It's a game. So if it weren't securities, let's say it was Monopoly, let's say it's DraftKings, it could be so much fun. Kramer said on Squawk Box, pick a couple of stocks, you gun them in the morning, and then you hope people are stupid enough and they buy them. Kramer referenced shares of American Airlines, which were up more than 15% in early trading, even as the company said it anticipates its second quarter revenues to decline 90%. Kramer stressed he does not believe it's investors on Robinhood who are driving up the equity prices, but it's sort of pump and dump scams from or schemes from these hedge funds, because usually those are the ones that can trade after hours. I don't believe that Robinhood allows you to trade in the after hours market, so it's most likely the big fish eating up the little minnows. Robinhood traders are not behind the rally and their favorites actually underperform, Barclays says. More Robinhood customers moving into stock has corresponded to lower returns rather than higher. So this is interesting. Silicon Valley startup said it saw a historic 3 million new accounts in the first quarter. Then at the end here, he goes on to say that, he quotes Jim Cramer that we were talking about. Now, Jim Cramer is a bit of a blowhard and entertainer, so I don't take everything he says very seriously, but I think there might be something to this, that the big money is coming in pre-market, buying up these stocks, and then releasing them onto the market. I mean, it's an interesting idea. It's as valid as anything else. So here's Jim Cramer again. Markets are in for a real bruising because everyone thinks they're smarter than Warren Buffett. I think to be in the stock market long term, you have to be very, very humble. And because you will have ups and downs, and the stock market will make a fool of you plenty of times. Then he goes on to talk about a whole bunch of different stocks that he thinks worth recommending, which I don't. I'm just going through a whole bunch of articles here, just the headlines mainly, just to give you a sense of what's happening in the upside down world, the topsy-turvy tales we're telling each other. Who benefits when the stock market goes up? Probably not you, and that's true. Posting some of its largest gains in history, even as the members in 1 in 2 American households have lost income. So talking about the stock market, posting some of its largest gains, well, 1 in 2 households have lost income. More than 80% of all U.S. stocks are owned by the richest 10% of U.S. households. Between 2007 and 2010, the median U.S. household's net worth sank by more than 40%. The median U.S. household had a net worth of 78 grand in 2016, and that's down from 120 grand in 2007. So in 9 years, lost, about 40%. That'll leave a mark. Then it goes on to say who is benefiting, and it's probably the high earners, those with a high net worth, and white households, generally because white households usually earn more money, because that's the kind of system we've developed here, a system of inequality and unfairness, which I hope is going to be changing in the near future. Kramer's week ahead. This is the most overbought market in history. Of course it is. I mean, anyone who's not saying that is either lying or has money invested in telling you that everything is hunky-dory. It got too easy, and now all we all have to suffer as the get-rich-quick crowd gets blown out, says Kramer. And then down here is what he's watching for. So he's watching for the Empire manufacturing numbers. Then on Tuesday, there's Lennar and Oracle earnings release. Then on Wednesday, there's the Fed speech and housing starts. Thursday, he's only worried about Kroger. I guess that the unemployment rate no longer matters. That comes out on Thursday too. And then on Friday is CarMax and Jabal. Anyways, interesting. I would stay away from the stock market, except that I'm short right now. But otherwise, I just be in cash. I think cash is a great position, as is precious metals perhaps, and also some cryptocurrencies, although as we'll see, cryptocurrencies are very risky. 46% of millennials say they're still recovering financially from the Great Recession, and we saw that earlier from the previous article where it spoke about how much net worth has decreased for most households, the median household, over the last 9 years, or from 2007 to 2016. This I found interesting. How do you anticipate the COVID-19 pandemic to impact your health, or your path to retirement? Now, I'm Gen X, and you can see here it's a severe impact. About 1/3 of us think it's a severe impact. So we think it's going to be the most impactful to us. And obviously that's because most of us are probably in our, mid to late 40s into mid 50s, I would guess. And so this is the time when we're really trying to double down to save for retirement, and it's going to have a severe impact. I certainly feel that way too. And this is why I'm trying to share these articles and engage in discussion, conversation with you guys about how best we can do to try and improve our long-term ability to save and have a greater future for ourselves. Okay, $1,000 is shockingly worth this much if you bought top 10 crypto assets in 2018. So now we're moving on to crypto assets. So how much do you think 1,000 would be if you bought crypto assets in 2018? And I'll give you a hint here. They said January 2018, an anonymous investor bought $1,000 worth of 10 crypto assets on January the 1st, 2018, and he put $100 into the top 10 at the time, and the top 10 were Bitcoin, XRP, which is Ripple, Ethereum, Bitcoin Cash, Cardano, Litecoin, IOTA, NEM, Dash, and Stellar. And those are still pretty good coins in my opinion. Well, it would be worth $205 as of June the 1st. So I guess that's 2.5 years. The $1,000 portfolio was worth $205.19. So, I mean, that's interesting. It goes to show you that, folks, cryptocurrencies is a very new asset class, and they're very volatile because they're new, and because of the volatility, they're very risky. So they could go down. But now this is a little bit of fear-mongering. It's a bit of choosing numbers to fit your narrative. So 1st of January 2018 to the 1st of June 2020, a $1,000 portfolio was worth $205. That's appalling. You've lost practically 80%. But let's have a look at this. So here is the 1st of January, okay? This is the 1st of January. And you can see here that the closing high price was 15,000 Bitcoin, right? I mean, you're basically putting money into these coins at the top of the market. No wonder you're going to lose money. And most folks, if they have any sense of what they're doing, either wouldn't be buying Bitcoin at these lofty prices, or if they are, they're doing some dollar cost averaging, right? It's what you should do. I'm sort of trying to buy in around here at about 9,000 to 10,000. But again, I'm doing dollar cost averaging. So it's about half the price of where it was. So potentially it could fall down to this low, let's say at around 3,700. I mean, it could fall down to here. It could fall down all the way to here. It could even go down to nothing, really. But, buying here is obviously a lot better than buying at the all-time high back then, right? And just to show you the advantage of dollar cost averaging, so here we've totally invested 1,080, and we started unfortunately 3 years ago, because you can't do 2.5 years here. So 3 years ago, and we started with $30, and we did $30 a month since then, right? That's when we decided to get in. And as you can see, this is the middle of December of 2017. This is the middle of January. So at around here, we're getting in, so almost around at the top, okay? But because you're dollar cost averaging, you can see that even from here, okay, you stayed down, you stayed below, you were losing money all through the end of December, where things really kind of tanked, and then they started to go. But if you kept going, you kept putting money in, by about April, middle of April, you've broken even, and from there you've made money. So if you dollar cost average from that point, you've still made some decent returns. In fact, you've made more than gold, and you've certainly made more than the Dow Jones, I believe this is. Yeah, that's the Dow Jones. So I think that's the key. You can go from buying right at the top here one time, or you can start buying at the top and dollar cost average all the way through this. And if you do that, instead of going from $1,000 to $205, you go from $1,000 to $1,600 roughly, right? $1,700. So that's why dollar cost averages is important, especially in an asset class like this, which is very risky and volatile. And this is what I'm doing. I'm not telling you what to do. I'm just giving you ideas to think about. You make up your own mind. Of course, I'll do me and you do you, and everyone will be happy. And that's just putting in $30 a month, right? And of course, with a volatile, risky asset like this, you don't want to put your life savings in necessarily. I'm aiming for perhaps a 2, 3, 5% portion of my overall savings into Bitcoin, with about another 5% in perhaps precious metals. At this stage, that's what I'm thinking anyway. All right, moving along, because this is getting long in the tooth. Cryptocurrency exchange CEO ordered employees to make fake trades, leaked documents show. Canadian exchange CoinSquare was practicing so-called wash trading. CoinSquare has been artificially inflating how much currency it is trading according to leaked emails, and this is generally illegal. Wash trading, which means it was automatically buying and selling currencies between accounts it controlled. So obviously I can't recommend, well, I won't recommend anything specifically anyway. I'll just tell you what I'm doing, but I certainly wouldn't put my money in with CoinSquare at this stage. If they're willing to do illegal and unlawful behavior like this, that's certainly not a company I want to trust with my money. Totes McGoat. Crypto hedge fund managers, Ether more like digital tungsten. And this is not a compliment, as you'll see. Ethereum does not have one of the greatest value propositions of Bitcoin, predictable scarcity. Instead, the antithesis is the reality, and the antithesis is the opposite, right? So they're saying it's not predictable scarcity. But at the same time, Ether is using up gas, I think. I think eventually they will stop producing more Ether. If I understand that correctly, you can correct me down below if I've got this wrong. But regardless, it's not so much Ether as being a Bitcoin, but Ether allowing for these decentralized apps and all sorts of smart contracts that can be built on the blockchain platform, right? That's what gives Ether its value, in my opinion. So it's not sort of a digital gold like Bitcoin, but rather a method of transacting across the blockchain, and I think that's what gives it the value. Here they don't understand what it's about. Given Ether's inability to adequately serve as a store of value, it remains a highly risky speculative instrument. Ether traders look to take profits from subsequent price changes over a short time horizon. They chase high returns coupled with high risk. Visions of digital ingots dance before their eyes. However, these visions are formed without evidence. Like Ether, they are pure speculation. Well, traders are speculating on anything. Generally, they're speculating on the price movement. That's all. They don't care about the underlying or the platform or the foundations or the fundamentals. So that could be true for anything, not just Ether. Ether, I think, has its value because of the smart contracts and decentralized apps that it's able to produce on its blockchain. So anyway, Vitalik Buterin comments on strange transaction fees. You've heard that there's been these $1 million transaction fees that have happened a couple times on a Ether trade. And so he said the $1 million transaction, TX transaction fees, may actually be blackmail, he said. Hackers captured partial access to exchange key. They can't withdraw, but can send no effect transactions with any gas price. And gas price is the amount of money you pay for the transaction, and it's used up in that transaction process. So they threaten to burn all funds via transaction fees unless compensated. I think this is probably just as well. You can see here that someone sent approximately $130 worth of Ethereum as of press time pricing, paying $2.6 million in transaction costs. So this makes a lot of sense to me, I think. And all I'm trying to show right here is that as much as I'm a huge believer in crypto assets and currencies, I think we need to remain vigilant because they are new. I mean, Bitcoin's only, the granddaddy of them all is only, I think, what is about 11 years old right now. So they're very new asset class, and of course they will attract pen testers or hackers and the nefarious as well. So because there's a huge potential, it's already been shown that the potential here is huge to make great gains. So be careful with cryptocurrencies. Do your due diligence, as I am doing when I buy. You have to be very concerned about the wallets you're using, whether that's hot storage or cold storage, which ones you're using, and which exchanges you're buying from, etc., etc. So there's a lot to be aware of, and you need to take your time to understand all of that. So this is really what I'm talking about here with the cryptocurrencies. As much as I think there's huge potential, they are risky, and they're riskier than precious metals, certainly because you can lose your private keys, you can lose your wallets. Exchanges can get hacked if you're keeping your money on exchanges, for example. If you have paper wallets, those can get lost, etc., etc. So just be vigilant and make sure you understand what you're doing if you choose to invest anywhere, really, with anything. Investors had better be wary of the advice they get from professionals. And I keep harping on this. These professionals are just telling us tall tales that they want us to think about, when in reality they have no idea. They have no real inside track other than they have maybe better spreadsheets and analytics. But they're making up stories to make us feel better, right? Which is perhaps arguably their role. But it's a very thin razor blade between telling tall tales and downright lies, right? And I think down here he goes on to say that the number of zombie companies that depend on continued low-rate borrowing to stay alive has been climbing. Why should anyone know the near future, and why wouldn't experts be resoundingly cautious? Because they're selling, right? Financial experts are in bed oftentimes with the companies that they're promoting or that they're analyzing, so they can't be too blunt and too open and honest with you. As experienced market watchers say, one of the two, equities or bonds, is right. And usually it's bonds. And bonds are not telling us a good picture right now. So I think we need to be cautious, folks. If you're in the stock market, be very careful. And I'm not in the stock market other than I'm shorting it right now because I can't. More that money is tied into a what they call a locked-in retirement account here in Canada, which means I can't access it. It has to be in stocks of some sort. And at this stage, down a fair chunk that I don't want to get out and put it into a gold fund or something like that. So I'm just holding tight. All right, let's see what the Magic 8 Ball has to say. And my question today for the Magic 8 Ball is, are Robinhood millennial traders driving the market? Let's see what the Magic 8 Ball says. Oh, so Robinhood millennial traders are driving the market. Folks, you heard it here first. Magic 8 Ball never lies. It perhaps tells tall tales, just like all the other analysts, but it's as valid as anything, including my own opinion. Hope you enjoyed that. Thanks so much for listening and having a conversation with me. I look forward to comments down below. Appreciate your time. Take care. Talk to you soon. And remember, dum spiro, spero.